same $300,000 IRA. Two couples. One pays $72,000 in conversion tax. The other pays $96,000. The gap is $24,000 and neither of them made a single investment mistake. The only difference was the year they converted. That gap has a name. I call it the Bracket Arbitrage Window. And if you have a traditional IRA and you are somewhere between 35 and 50, there is a very good chance you have one opening in front of you right now. And you are about to let it close without touching it. Today we are running the real math on Roth conversions, not the retirement age version you see everywhere else. The version for people in peak earning years who have a low income window coming, a sabbatical, a parental leave, a business loss year, a layoff bridge, and have no idea that window is worth tens of thousands of dollars. If you want more breakdowns like this, specifically Math First, built for people actually in the middle of building wealth, subscribe to Sarah's Money Map. The numbers here are going to move fast. Now let's talk about what a tax bracket actually costs you when you convert. A Roth conversion is simple on the surface. You take money out of a traditional IRA, pay income tax on it that year, and it moves into a Roth where it grows and withdraws tax-free forever. No required minimum distributions, no tax drag on the back end. And since 2010, no income limit. Anyone can convert any amount, any year. The question is never whether to convert. The question is which year, and at what marginal rate does that money get taxed. Here's what the 2026 brackets look like for a married couple filing jointly under IRS Revenue Procedure 2025-32. After the standard deduction of $32,200, the 22% bracket runs from roughly $47,150 to $239,950 of taxable income. The 24% bracket runs from $239,950 to $436,350. The 32% bracket starts at $436,350. Now picture two couples. Both are 41 years old. Both have $300,000 in a traditional IRA. James and Claire earned $450,000 combined this year. After the standard deduction, their taxable income sits at around $417,800. They are deep in the 24% bracket, close to 32. They decide to convert the full $300,000 now, while they feel financially strong. The conversion pushes their taxable income to $717,800. The conversion amount gets taxed across two brackets. The slice from $417,800 to $436,350 hits 24%. Everything above hits 32%. Blended effective rate on the conversion, roughly 32 cents on the dollar. Tax bill on the conversion alone, $96,000. Kevin and Priya earned the same salary. Same IRA, same balance. But Kevin took parental leave this year. Priya's consulting practice had a slow quarter. Their combined income is $220,000. After the standard deduction, taxable income is $187,800. They are sitting in the 22% bracket with significant room. They convert the same $300,000. The conversion fills their 22% bracket and spills into 24%, but never touches 32. Blended rate, roughly 24%. Tax bill, $72,000. Same IRA, same amount, $24,000 difference. Gone. This is the bracket arbitrage window. It is not a loophole. It is the IRS telling you openly that different years cost different amounts. Most people never check the calendar before they convert. But the $24,000 gap is just the starting number. There are two more layers sitting on top of it. The first layer is the net investment income tax. Above $250,000 of modified AGI for married filers, a 3.8% surcharge activates under IRC Section 1411. A Roth conversion adds directly to your AGI. James and Claire, already earning $450,000 before any conversion, are well above $250,000 from day one. Every dollar they convert triggers the full NIIT exposure. Kevin and Priya at $220,000 base income convert into a much smaller NIIT zone. The gap between the two couples widens past the initial $24,000. The second layer is IRMAA, the income-related monthly adjustment amount. Most 41-year-olds have never heard of it because it does not hit until Medicare at 65, but IRMAA uses income from 2 years prior. A conversion spike today becomes a Medicare premium penalty at 65. The 2026 surcharge thresholds sit at $212,000, $266,000, $334,000, $400,000, and $500,000 of MAGI for married filers. Each tier adds hundreds of dollars per month to Part B and Part D premiums. James and Claire converting $300,000 in a peak income year can cross multiple tiers. Kevin and Priya converting in a lower income year keep their IRMA exposure contained. That is a delayed tax on a current decision, and it compounds for years. Let me put this on a graph. Picture 2 bars. The first bar is Kevin and Priya's conversion cost, $72,000. Sitting in the 24% zone, NIIT minimal, IRMAA manageable. The second bar is James and Claire's conversion cost. It starts at $96,000. The bar just grew. Then the NIIT surcharge adds another layer. The bar grew again. Then IRMAA 2 years later adds hundreds per month across retirement. The gap between those 2 bars is not theoretical. It is money James and Claire will never see again on the exact same account balance. Now you might be thinking, Kevin and Priya had a soft income year. They did not plan it. What if I never get a low income window? This is where the strategy shifts from passive to active. The bracket arbitrage window does not have to happen to you. You can build one. The most common engineered windows for 35 to 50-year-olds, a sabbatical between employers, a parental leave year where one income drops temporarily, a year of heavy business deductions that compress AGI, or a year you max contributions to a pre-tax 401k, HSA, and SEP IRA simultaneously. Any of these lowers your taxable income. Any reduction in taxable income is a lower marginal rate on converted dollars. And here is where it gets precise. You do not have to convert the entire $300,000 in 1 year. This is what I call the conversion ladder. You identify the specific dollar gap between your current taxable income and the ceiling of your current bracket. Then you convert exactly that amount. Fill the bracket, stop. Next year, same analysis, same discipline. Say your taxable income is $160,000 in a lower income year, married, filing jointly. The top of the 22% bracket sits at around $239,950. You have roughly $79,950 of 22% bracket remaining. Convert $79,950 from your traditional IRA. Every dollar converted at 22% instead of 32% saves you 10 cents. On $79,950, that is $7,995 in tax savings in a single year, without touching the 24 or 32% brackets at all. Run that conversion ladder across 3 low-income years. The savings stack, and the Roth account on the other end grows tax-free, skips required minimum distributions, and passes to your heirs under Secure Act 2.0. Without the 10-year forced drawdown that traditional IRA accounts now require for non-spouse beneficiaries. For viewers in their 40s with kids, the estate advantage alone is significant. One mechanical detail before you execute. Each Roth conversion has its own 5-year holding period for penalty-free withdrawal of converted principal under IRS Publication 590B. If you are under 59 and a half and you convert in 2026, you can withdraw that converted principal penalty-free in 2031, not in 2026. The conversion ladder works best when you are not planning to access converted funds immediately. Know the clocks before you pull the trigger. Here's the protocol. Step 1 is to calculate your projected taxable income for this year. Take total household income, subtract your standard deduction or itemized deductions. Subtract pre-tax 401k and HSA contributions. That number is your baseline taxable income before any conversion. Step 2 is to find your bracket ceiling. The 22% bracket ends at $239,950 for married filers. The 24% bracket ends at $436,030.50. Subtract your baseline from the ceiling of your current bracket. That is your conversion capacity at the current rate. Step 3 is to convert up to that number, not past it. $1 past the ceiling means the next bracket applies to everything above the line. Precision matters more than speed here. Step 4 is to verify your MAGI stays below the relevant NIE and IRMAA thresholds before you execute. If the conversion pushes you above $250,000 of MAGI, the 3.8% surcharge activates on investment income. Run the full number, not just the marginal bracket check. This is not a one-year decision. It is a multi-year map. The conversion ladder is built one rung at a time, and the use your income cooperates, planned or accidental. Vanguard's How America Saves 2025 report found that 36% of employer plans now offer in-plan Roth conversions, up from 12% a decade ago. The infrastructure is expanding. More people have access than they realize. The bottleneck is not access. It is knowing the window exists. Your traditional IRA is not a passive account sitting quietly in the background. It is a future tax bill with your name on it. The total size of that bill depends almost entirely on which years you choose to pay it. The conversion ladder does not change how much money you have. It changes what fraction the government keeps. Every year you spend at peak income without converting is a year you are paying 32 cents on Roth dollars. You could have converted at 22. The meter runs. The window does not wait. Drop a comment and tell me what your current bracket looks like or whether you have a low income year on the horizon. I want to see where you are on the map. And if this gave you something you can act on this week, hit like. It helps this kind of math-first content reach more people who need it. I will see you in the next one. This video is for educational and entertainment purposes only. I'm not a financial advisor. Investing involves risk, so always research before making decisions. AI tools may be used, but the final content is checked and edited by me, Sarah.